Hello guys, you are welcome to today's video. In this video we're going to be talking about momentum, but I just want to quickly show you something. I wanted to show you an entry on VIX 75. Alright, so look at that entry guys. This is the 1 hour chart. What's your definition of sniper entry? You see guys, the strategy is the same. Alright, well, today I want to be talking about something a little bit different. Alright, so I'm going to be talking about momentum today, okay? When you are looking to take trade, guys, you want to really have some checklists, okay? You want to have checklists. And amongst that checklist is whether you have momentum on your side or whether momentum is already dropping from the counter trend. So let's say for instance you want to buy, all right, and the market has been dropping to a level. It drops to a key level, okay? So if market has been dropping and then as it gets to that key level, you want to see momentum drop from behind price. So as price is dropping and as it approaches the key level, you want to see momentum drop off from behind the price. When you are looking for entries, that is one thing that must be amongst your checklist. So you have gone through your chart and you have marked out your key level, and then the next thing is when price is approaching your key level, one of the things that should give you assurance that your key level is going to hold is that you begin to spot momentum drop off from behind the price trend that is bringing price to your key level. Do you get the point? And then you can now bring in things like a break in market structure after you've seen the price trend drop and the price momentum drop off. So you can now bring in things like a break in market structure to see that, okay, you are now having momentum reversing and then price is also beginning to reverse. Do you understand? Maybe I can just use this one as an example. All right, so let me pull up so this is going to be based on we're going to use an indicator. This is what some people call divergence. All right, now when it comes to divergence, I don't use the second type of divergence, which is hidden divergence. Hidden divergence is for continuations, and so I'm not going to bother even teaching about it here. All right, so the only thing that I use is regular divergence. Why? Because regular divergence allows me to trade in an area where there's higher probability for my trade coming to fruition. Regular divergence allows me to trade on the key levels. It allows me to trade in the key levels. So that is why for me regular divergence is what makes sense. All right, so regular divergence is one of those tools that I use, and you can use that as well. All right, but it's not just everything. It's not just everything. So let's go. Let me just let's rationalize that we have a key level now. I'm not saying this is a key level, okay? But let's just say we have a key level right around that area. All right, so let's say we have a key level around that area. So when price dropped out from that point, we are now saying that we are expecting price to get into that point, into that area again, and that's where we are looking to trade. So we are saying that shaded area is our key level. So how do I define divergence? I define divergence like this: when price trend and momentum begins to disagree, that's when we are having a divergence. And you don't just want to trade the divergence anywhere. That's one mistake that a lot of people make. So you want to make sure you have a key level where you have your eyes upon. All right, so it makes a lot of sense then to understand how price is traveling and how when it gets to your key level, you want to be able to see that momentum is dropping. So you don't want to be taking those trades anywhere. I belong to a group on Facebook where somebody, his style of trading is just divergence. And really, I'm not saying this. If that person is here, one of these days I'm going to post this picture, and the reason why I'm posting it is for people to learn. Okay, and let me even apologize beforehand. If that person is here, don't feel offended. Okay, and if you've been trading divergence like that, you don't have to feel offended. So the guy trades divergence just anywhere. It takes the hidden divergence, it takes the regular divergence, and all of that. So you don't want to be doing something like that. You need to understand what gives you a higher probability of win. And so when he took this hidden divergence that he took, I think it was hidden divergence or so. So his risk to reward doesn't make any sense. It was not even up to 1 to 2. You understand? You don't want to be taking trades like that. You want to be taking trades that gives you a very sound risk to reward and a very high probability. You understand the point? So your best bet is a key level. And what is your key level? Your key level is a reaction point on the higher time frame. Then your entry is going to be on the lower time frame. So when price is approaching your key level on the lower time frame, that is when you are looking to spot your divergence, number one. And then you're looking for price to begin to agree as it hits your key level. You are looking for price to begin to agree in the direction of the trend you are looking to trade. That is how you take your entries, guys. That is how you take entries that will win money for you. All right. So let's just rationalize that area up there is our key level. All right, that shaded area, the gray area. And so we saw price rising up to that point. Now this is when I can only bring up an indicator on my chart. So like I said, divergence or regular divergence. I don't use hidden divergence. Regular divergence is when we have price, the price trend and the momentum disagreeing. All right, so we use indicators to measure the momentum. All right, so let me show you right now how this will look on a chart. Okay, so let's add the indicator to use. Yeah, so you can use any indicator. You can use the RSI, you can use the stochastic, you can use just anything. You can. Some people use the unbalanced volume. That's the OBV. You can just use anything. All right. So, but I like to use the MACD, and the RSI is good as well. So let's just use the MACD. We leave the setting 617.1. All right. So this is it. I don't need to pull up this indicator for me to see a divergence. All right, a divergence can be seen in the market structure, but when you use indicators, it make it easy on your eye. So that's just the advantage of using indicators. So we see price coming to our key level. If divergence begin to happen around here to here, that's not our business because price has not yet getting to our key level. All right, so what I'm showing you right now is an example of a bearish divergence. So you can see price get to the key level now, right? So price has gotten to the key level, and then we begin to see the trades. Price begin to trade into the key level and trades even deeper. So when you look up there, you will see price making higher highs. All right, price is making a higher high. Can you see that? One high, a higher high here, another high here, but not as high as this one. So basically the price was making higher highs as it was going. So when we are talking about the bearish divergence, price will be making a higher high, but the indicator will be making a lower high, just like you see right here. You see? So instead of the indicator to be making a higher high just as the price trend was making a high high, we now see the momentum indicator, which in this case is the MACD, making a lower high. That shows that momentum is now dropping. What you want to do now is to wait for price to agree with the direction you want to be trading in. So you're looking for what? A break in market structure. You know, I posted a video here, understanding market structure, and some people still make mistake while taking trades, and they don't understand why they have losing trade. Go and watch that video. It is a 1 hour video, but if you love yourself and you want to keep trading, you want to be profitable trader, and you don't really understand much about market structure, you should go and watch that video. Don't just think I posted the video there for people to give me views or whatever. No. It took me time to create a 1 hour video. I hope you understand that. So I did that because I keep seeing people complaining, and people, I don't know why. Most people are just looking for one magical strategy, and you just show them something in 5 minutes, in 3 minutes, and they just want to run off with that. That's not how you are going to become a profitable trader, guys. You understand? If that's the way you are looking to become a profitable trader, then you're going to swallow down everything and anything that people gives you. You want to approach these things with logic. Understand that there's a process. Okay? There are things you need to understand, and one of them is price structure. Another is what I'm giving you right here. If you can understand price structure and even understand just this one alone, together with price structure, that's it. You have a strategy right there. You can make a strategy out of that. Now, of course, you need to understand what reaction points are. Like I've marked out that area, and you see me take a trade around that point. Okay, so you need to understand what reaction points are, so that when you go look for those reaction points on your higher time frame, that becomes your key level to trade from on the lower time frame. You get what I mean? So let's go back to the study, okay? So we talk about structure. Now we have momentum agreeing with the direction of our trade. We want to trade down, so momentum is already dropping as it approaches that key level, showing that price is somehow respecting the key level, right? But now we want to see price show us truly that it is respecting that level. So what we saw higher highs going up like that, just like that. So we want to see price break the market structure. We want the change to break. This is where you have a change in the structure. Price makes a lower low right here with close below the low. So it makes a lower low right here. You understand the point? And then retraces back. This could have been your entry. This could have been your low risk entry right here, this point. And I have tools that will make you know that this is an entry. This could have been a sniper entry for you if you understand certain things about the market. All right? And that is why I'm putting out my 4x premium, out there, my 4s clause, my 4s course. These are things that are discussed there. Right? Oh, goodness. So this could have been your low risk entry. So first of all, we have a key level. Second, as price is approaching that key level, we want to see momentum begin to drop off. As momentum drops off, you can now understand that momentum is agreeing with your trend, where you are looking to trade towards. But you need price to agree, because there are times when momentum can drop and then pick up again, and the trend will continue. There are times like that. So that is why you need the price to confirm to you. So the things that you have going for you is, number one, your key level. Number two, your momentum begin to diverge from the price trend. Number three is that you want to see price break the market structure. And that means that we are now most likely to begin to see price going down. This would have been your low risk entry if you understood certain things about the market. So this is for a bearish divergence. So a bearish divergence is one where price is making higher high. A bearish regular divergence, all right? So a bearish regular divergence is one where the price is making a higher high, but the momentum indicator below is making lower highs. So you can see, just focus on the arrows that were drawn above price and below the indicator, below and above indicator. So when you are drawing a bearish, looking for a bearish divergence, you are going to draw your lines across the highs, the high of price and the high of your indicator. All right, so let me look for an example. I'm not in any trade that has to do with sell right now. All of my trades are in buys. So let's just take an example of what that will look like. Okay, so now we have an example here. A bullish divergence. This is a bullish regular divergence. So let's just assume that we have a key level right here. Let's just assume we have a key level. Right below that point. Okay, below there. So let's assume that that shaded area is our key level. As price gets into the point, or maybe this one is, maybe let's just use something else. Let's use something else. I want you to see it very clearly. All right, I just want you to see it very, very clearly. We don't have anything here. There's no divergence here either. What does it look like? The market has not been selling. So you want to make sure that you are using this in at only key levels. All right, so that's why I like to use the regular divergence concept. I like to use it because it allows me to trade off from the key level. So let's use this one. I think this one is clear enough. Okay, so as we saw price coming down, this is the version of a bullish regular divergence. So when you draw your lines, this is a rule. You don't want structure, you don't want price to interfere, right, with it. You don't want price to interfere. You don't want price to break the line. So you just have to be straight from a low to another low. So from a low to another low. So price here is making lower low, while here on the indicator is making a higher low. So this is divergence. This is a bullish regular divergence. So price is making a higher low on the indicator, whereas it is making a lower low in price trend. All right, so as it approaches the key level, you are expecting to see this happen. You are expecting to see this happen. You are expecting to see price momentum begin to respect your key level, even as price continues to trade down. It is showing you that the momentum behind price. Now, the trend needs momentum to continue. More like your moving car needs force to continue going. The moment they turn off the ignition, you will see that, okay, even if they don't match the brake, at some point that car is going to stop moving. Same thing with price. Do you understand? Same thing with price. So when the momentum begins to drop off as we get to the key level, it begins to give you an information of what is happening in price and saying, okay, as price is getting to this key level, it is respecting our key level, more or less like the brakes are being applied. But you don't just jump into a trade until price begins to agree, which is what you have right here. All right, so price broke this market structure here. You have a break in market structure right here. So when price traded above this level that I just drew there, that's your break in market structure. And that's it. You see the movement in price. This little retracement would have give you an entry if you understood. Only if you understood. So that is for divergence. All right. So I hope you understood the point. You are going to be using this in line with your key levels. Your key level is the reaction point on a higher time frame. And in the video of structures where I taught you on, just a general way of applying structure, I showed you that the best key levels are going to be your key levels that are on higher time frame. Is going to be reaction point on higher time frame that is in line with the trend. So there's a trend and price makes a retracement into a reaction point, and all of that is you're going to be doing the analysis on a higher time frame. So when you come to the lower time frame, that is when you are looking for price trend to begin to respect that level you've drawn, number one, and then you're waiting for the trend of price to reverse. And all of that I talked about in the other video. So here, this one is just about momentum, right? So we have momentum drop off as we get to our key level, and then we want to see price change the trend. All right, so hopefully this was a this added something to you. All right, you use this around your key levels. So yeah, that's it for this video, guys. Um, give me a thumbs up for this one if you love it, and if you've not yet subscribed to our channel, subscribe because we give great stuff, great content all the time. And if you're interested in learning more about trading and you really want a very sound strategy and easy to apply and gives you a very high risk to reward ratio, and you want to really master trading, then you want to talk to me, okay? You can chat me up on Telegram. My link will be dropped at the description on the description link below, or in the description link below, and then I think I'll drop my Facebook link there, and maybe you can chat me up on Facebook as well if you so desire. Okay? So whatever questions you have, drop a comment. I welcome comments. All right. So see you in the next video, guys. And in the next video, I think I'll be pointing out some few things that's gonna bless you as well. All right. So every time back to back, we're doing this. Okay. Enjoy, enjoy, enjoy. Goodbye.